Hello, my name is Alan Mackey and I'm the Managing Director of Campbell Mackey Limited. An area that I've seen a significant increase in interest in recently is the topic of inheritance tax and the strategies that can be used to reduce or even eradicate the potential tax liability faced by a loved one's estate. In the first stages, an initial consultation and discussion will quickly be able to identify if there is in fact a potential issue with inheritance tax at all. Where there is a liability, Campbell Mackey Limited will prepare a customised report that will identify the extent of that liability and lay out a range of strategies to deal with the problem. Inheritance tax is one of the few taxes that to a certain extent is voluntary. When I say voluntary, I mean that it is possible to legally avoid paying inheritance tax if you're willing to be proactive with your planning. The careful use of wills, the gifting of capital to your eventual beneficiaries can all help to reduce the value of your eventual estate below the inheritance tax threshold. Obviously, specialist advice is required to ensure that this type of planning has been done and is effective. Where these measures cannot be fully utilised, then the use of trusts can assist in the planning strategy. Gifting capital within a trust can often meet a client's requirements to firstly maintain access to the income from their capital, to maintain control over who eventually benefits from their capital after their death, and at the same time allows the inheritance tax planning to take place to reduce the tax payable by their estate on death. The following example will hopefully illustrate the potential benefits of using trust arrangements. The following case study is a real-life case study. The client in question, Mrs T, we'll call her for the purpose of this exercise, had two sons. Plenty of capital at her disposal, but a very small state pension. But she was very aware of the potential inheritance tax liability that was going to fall on her estate when she eventually passed away. So she wanted to undertake some proactive planning to try and reduce that liability as far as possible. The planning commenced in April 2005. Mrs T passed her amount over to us of £270,000 that was placed into a gift trust, and the gift trust is treated as a potentially exempt transfer, and as long as she survives for a period of 7 years, that gift falls out with her estate. She required income from the trust, and the income that was set was at the level of £13,500 per annum, and that £13,500 per annum is tax deferred for up to 20 years. If nothing else had taken place and Mrs T had passed away shortly after the planning was undertaken, the inheritance tax liability would have been reduced by £108,000. As it so happens, the planning is now run forward. We're at a stage where the gift has fallen out with the estate and fell out with the estate in 2012, which was the 7-year anniversary of the planning. She's received tax deferred income over the period of over £135,000, and the current value of the trust stands at £345,535. That equates to total growth over the life of the trust of 78% against a backdrop of the worst financial crisis we've seen since the 1930s. In summary, I hope you agree with me that this kind of planning, proactively undertaken, can have the desired effect of mitigating the inheritance tax liability, maintaining income for the individual through the rest of their lifetime, and by careful use of the trust also ensure that the capital goes to the destined beneficiaries as required by the individual. I hope that the example that we've just given you gives you a clearer insight into the kind of proactive planning that can be undertaken. If you're interested in taking this any further or would like further information, please contact me at the details on screen. Thank you.